I've been consistently profitable off of a subject in trading called the trader's trap. In this video, I will reveal the secret strategy behind the trader's trap and why it is not talked about in most YouTube videos. The best thing about this strategy is that you don't need to use any special indicators for it to work. Just simply consolidation and supply and demand. After weeks of backtesting to see if this strategy actually works, I was left with the win rate of about 50%. But the surprising part was that I was profitable the whole time. Sounds crazy, right? Wrong, and I'll tell you why. Even though I was right only 50% of the time trading this strategy, my wins outweighed my losses in terms of profit. You see, even if you lose half of the battle in the market, this strategy will allow you to achieve long-term profit with a low win rate percentage. So let me show you how to consistently catch these trading traps and profit off of them. The basic idea to identify these trading traps is to look for a trend and a consolidation right after. This is where a lot of traders see a specific pattern known as a bullish flag, just like this one. The thought process of these traders when they see a pattern like this is to assume the trend will continue higher after the consolidation period. So they would enter the trade right after the price breaks out of the consolidation area, hoping it will rise upwards. What happens is buyers will see this break of structure and enter the trade with their stop losses usually below the consolidation. And this is a logical place to put a stop loss, but the problem is when the market decides to reverse. Now, all the buyers have their stop loss around the same area and get trapped in this fake trend upwards. This creates a huge momentum change in the market, just like a domino effect, with multiple buyers selling off their trades. This is exactly what we want to see to catch the reversal of the trend to make a lot of money. While other people are selling off their buy orders, we can take advantage of this and place our sell orders in this area here, while we look for a retracement of the previous trend, where we can look for a 2x, 3x, or even a 4x of the amount we bet. What I like to do once I've entered the trade is to look at the higher highs and the lower lows of the candlesticks. This tells me if the trend will continue to go in my favor, so that I don't lose out on extra profit during the trade. This right here is the confirmation you need to look for when trying to make a profit off of reversals. For example, if the trend broke out of the consolidation and continued to rise without rejections, we would not place a sell order short because it doesn't follow the strategy, and the odds of it reversing are not in our favor. Whenever I see a big change in momentum and multiple rejections, this is a sign for me that the trend has a strong chance to reverse and catch those traders trying to buy with the trend that have their stop losses below the consolidation. If we look more closely at the specific candlestick, we can see a large rejection with the candlestick closing with a bearish pattern, making it even more likely that the market caught liquidity in this area and will now try to trend in the opposite direction. One of the most common problems with newer traders is that they will usually exit the trade once they see a pullback, but do not do this. It is normal for the market to have multiple pullbacks during the trend. This is one of the hardest skills to learn, since seeing the market play out live can really affect your trading. Understand that not every trade will go in your favor. This is why it is important to stay in the trade for as long as possible, even if you have a 50% win rate using this strategy. In the long run, you will be profitable if you can manage your emotions during the trade. An easy fix for this mental barrier is to put your stop loss at break even once the trend has enough momentum to reverse. This will give the market enough space to have multiple pullbacks, but you won't lose any money if the trend continues to head upwards, saving your capital for a better trade in the future. Sometimes it can be hard to find where these trading traps could happen in the market. What I found to be useful for this problem is to mark out supply and demand levels where the price seems to bounce off multiple times. These areas are where the liquidity sweeps happen, making it more likely for the chances of the trend to consolidate with a very strong reversal afterwards. I go more in depth in my previous video about supply and demand, which you can find in the description of this video. Suppose you followed all the previous steps I showed in this video perfectly for where to enter the trade, and you decide to let the trend continue to go in your favor with a stop loss at break even. The next problem you'll eventually run into is, where should I exit the trade? What I discovered using this strategy to help me with exiting the trades at the right time would be to look at the previous supply and demand levels. Just like how we used it to enter the trade, we will now use it again to exit the trade. The chances of a trend to break past these levels are very low. What would this actually look like during a live trade? What you'll notice is that the trend will start to slow down and consolidate. This is a good indicator to exit the trade, in case it decides to make a big retracement. Remember, it's more important in the long run to save your capital. The market is unpredictable and you just have to take what it gives you. Here's another example of this strategy in action, where I wait for consolidation at the bottom of a trend at a demand zone and look for a false breakout to happen. As it trends upwards, I can see that the candlesticks are showing rejection and momentum changes. Then, I would place my sell order right above the consolidation, where most of the traders have their stop losses that believe the trend will continue lower. After my sell order is placed, I let the market continue to move, taking profit and putting my stop loss at break even, and exiting the trade where the next supply zone is located. Trading is a process and you will not win every single trade. The objective is to put yourself in a situation where the odds are in your favor, giving you an edge in the market. Once you're able to understand and witness trading traps for yourself, you will be unstoppable. If you enjoyed this video, remember to leave a like. Thanks for watching, and I'll see you in the next one.